What a very strange moment here. Federal Reserve is committed to cutting short-term interest rates, but long rates set by the bond market have soared. And that's holding back all sorts of stocks, especially the high yielders that most directly compete with bonds. Take Realty Income Corp, the real estate investment trust that owns more than 15,000 properties, mostly retail focused. This REIT is famous for its reliable monthly dividend payments, which currently yield more than 5.5%, substantially better than you get from the bond market. However, the stock would be a lot more enticing if long rates were going down rather than going up. Don't forget, these guys are dividend aristocrat. Realty Income rallied 20% in the third quarter in anticipation of that first rate cut from the Fed. But as long rates have climbed relentlessly in October and November, the stock has been crushed. Didn't seem to matter. The REIT reported a very solid quarter early last week, even raising its full-year forecast. So what do we do with this high-quality dividend stock now that it's pulled back from its highs? Let's check in with Sumit Roy. And he's the president and CEO of Realty Income to get a better sense of what's happening. Mr. Roy, welcome back to Mad Money.
Thank you very much for having me, Jim.
Okay, so help me here. You just reported great numbers. The dividend, safe, keeps being raised many, many years. We love the monthly dividend. We look at the stock, and we presume that there must be something wrong. Could you please explain to people that it has much more to do with long rates than it has with your portfolio?
Exactly right, Jim. The exogenous factors here is absolutely the 10-year Treasury. Even if you just look at what's happened over the last 6-7 trading days post-election results, it's trying to find where the settling out period is going to be, and it's gone up about 30-40 basis points during that period, which obviously has an impact on our stock. You know, the things that we can control, like you said in your introduction, our ability to continue to perform regardless of the volatility that we are experiencing. That's what this company is built on. We are a highly diversified, 80 billion plus enterprise value company that believes in distributing dividends. And we've done that since our listing in '94 every year. And I think this too will pass. The market is trying to adjust what are the policies that will come through, what are the priorities of this policy, and what's going to be the inflation expectation longer term. And as soon as that happens, I do believe that backdrop will be very conducive for us to continue to perform.
Well, I have to believe that historically the relation between, say, the longer-term bond and you is such that if you bought it when the stock broke down, and this has happened twice to me with your company in the last decade, it has always been the right thing to do. And I'm therefore presuming, at least historically, it would be the right thing to do again.
Yeah, you're absolutely right. In a rising interest rate environment, which is what we experienced, from '96 to almost 2006, in that time frame, the 10-year was trading north of 5%. It wasn't necessarily a rising interest rate environment, but it was an elevated 10-year Treasury. We continue to perform. We grew our AFFO per share, which is a proxy for our earnings, at a 5% level. Then in an environment, when you look at 2008 to 2022, where the 10-year was somewhere in the slightly north of 2%, we still continue to perform and generate earnings north of 5%. So for us, it's not really where the Treasury, the 10-year Treasury ends up. You're right, in the short term, there's an inverse correlation. It's just once that volatility is out of the market and we have a stable backdrop to execute on transactions, that's what we are able to do. And so, like I said, there's a bit of a feeling out process by the market to absorb what are the policies that are going to dictate the next 3 to 4 years. And once that happens, I think we'll be in a good place to continue to be that net lease company of choice.
All right, so let's be sure that some people are saying to me, Jim, you're whistling past the graveyard. They've got a big position, a tenant position with Dollar General, big with Walgreens, big with Dollar Tree. These are no longer the kinds of credits that you want. How do you respond to that?
For me, there are the headlines, and we discussed this during our earnings call last week, where they talk about $600 Walgreens stores closing down. And the reality of the situation is we had 13 Walgreens coming, had lease expirations this year, and all of them were sort of renewed. And so it's a similar story with our Family Dollar situation. In our history, we've had more than 100 leases renew, and we've recaptured north of 106%, 107%. renewal spreads. And so, the reality does not sort of match up with the headlines. It is true that Family Dollar as a brand is going through some growing pains, and that was one of those M&A transactions that Dollar Tree did, which hasn't sort of come to pass. But that too is going through a repositioning, and I think we've touched on this before in your show, Jim. We buy assets that we believe has a slew of alternative tenants ready to come in. And even in a situation where we do get back assets, we're very confident in our ability to reposition it. And that's been the case on some of the Family Dollars that we've actually proactively approached Family Dollar and said, can we have those back? And because we've had a couple of very large national retailers who want to step into that position. And so we feel very confident about our ability to continue to produce results, regardless of some of these headlines that dominate, the news.
Well, I'm so glad you said that. To me, it's just been entirely related to 10-year. Very, very rarely do you get this kind of break to be able to buy your stock, which is a straight-up stock. I want to thank Sumit Roy. He's the president and CEO of Realty Income, letter O, monthly dividend aristocrat for more than 25 years. Mad Money's back after the break.